Welcome back. Russia is experiencing its worst drought in 50 years. That spurred wheat prices to their biggest one-month jump in more than 3 decades. Russia's National Weather Center now says that planting scheduled to start this month may not happen. Wheat prices have hit a 22-month high out in Chicago, and food industry executives are warning that prices could go even higher. And since we've got our eye on the commodity front this morning, we wanted to bring in Edward Morse. He's head of global commodities for Credit Suisse. He joins us from there right now. Ed, you know, these pictures of Russia and the drought and the fog from the smoke and the fires there, they've raised a lot of concern about what's happening with wheat supply. Do you think that we will see Russia stop exports?
It really doesn't look likely. It looks as though the facts are that there's a drop in wheat availability, but there's still a surplus for exports. The estimates are that that production for exports will be down by 25%, but there's still a relatively healthy surplus. But markets are tightening because of what's happening there, and ironically because of flooding in Canada, which is affecting the Canadian wheat crop.
Do you think that the global markets have priced in all the concern about that Russian Black Sea region?
Well, there are two aspects to it. First, I think the big jump that we've seen, not last month, but the couple of days today, are based on the request that Russia call a force majeure on exports, and that was done by a trading company, and that might have popped the price up a little bit higher than might otherwise be warranted. On the other hand, there really is concern that the winter wheat crop might not be planted, and if there is a major export problem, it would come with the winter crop.
Now, let's switch to crude oil, because we've seen a real run-up in price of late. A lot of that credited to a weaker dollar today. A little bit of a change there. Talk to me about how you read today's supply figures.
Well, first, a lot of the run-up was due to the dollar, but the oil complex has been relatively strong since June. And the latest increase in crude prices needs to be put in the context of field maintenance in the North Sea, and we've seen the premium that WTI over Brent a couple of weeks ago, $1.80, turning into a discount yesterday. So it was driven as well by real physical market shortages. On the other hand, the data that came in today are relatively weak. We're showing inventory builds. Crude was drawn a little bit. On the other hand, we're still at record levels for crude inventory, and refinery runs are up, and demand is going nowhere. So all in all, I'd say it's a not very bullish report.
Well, Bank of America was handicapping a 1.4 million barrel capacity being taken out of the market because of refineries being shut down over the next 6 months. Do you agree with that? I mean, what are you expecting?
Well, we're expecting about 3.5 million barrels a day of refinery closures in the Atlantic Basin. That's more or less normal. It's going to happen in September and October, and that should, as is seasonally normally the case, result in a crude build and a products draw during that period of time.
You know, it's interesting, Ed, in sort of a broader context, that we're talking about oil prices running up as a weaker dollar and perhaps signs of hope and economic growth. At what point do we start talking about oil prices hampering growth and being a pressure on the consumer?
Well, almost certainly one of the trigger points for that is going to be the renewal of the Bush tax credits, and there are fear estimates that if the tax credits are not renewed, that will hit U.S. GDP and demand growth in the U.S. economy, and that should have an impact on global commodity prices, oil prices in particular.
When do you expect to start seeing that?
I think this is an end-of-the-year scenario, and if we see GDP continuing to fall below expectations, I do think what you're implying is right, that the downside price risk is much greater than any upside potential above where we are now.
We'll watch. Thank you, Ed Morse, joining us from Credit Suisse this morning with a commodity check.